Most people evaluate a job offer by looking at the salary. That number is visible, easy to compare, and immediately translates to a sense of financial position. What is less visible, and what most people significantly undervalue, is the total compensation package beyond the base salary. Employer benefits represent a substantial portion of the true economic value of employment, and many of them are either free money in a direct sense or tax advantage tools that meaningfully reduce what you pay for things you would be buying anyway. This video covers the major categories of employer benefits, how each one works, what the financial value of each actually is, and what specific actions maximize the value you capture from them. The employer match on a retirement plan was covered in the previous video, but deserves reiteration here because it is the single most valuable benefit most employers offer. When an employer matches retirement contributions, they are adding dollars to your retirement account that you did nothing to earn beyond contributing your own money first. A 50% match on contributions up to 6% of a $60,000 salary is $1,800 per year in additional compensation that does not appear on your offer letter and is invisible unless you look specifically at the benefits package. Not contributing enough to capture the full match is leaving a defined, guaranteed sum of money on the table every pay period. It is the closest thing to free money that exists in the employment context, and it should be the first financial action taken upon starting any job that offers it. Health insurance is typically the largest non-salary benefit by dollar value. Employer-sponsored health insurance is a group plan that covers all eligible employees and often their dependents. The total cost of the premium is shared between the employer and the employee. The employer's share of the premium is a significant subsidy that is not reflected in your salary. The average employer contribution to employee-only health insurance coverage is several $1,000s per year, and for family coverage, it is substantially higher. This subsidy is also tax-advantaged. The employee share of the premium is typically deducted from pre-tax income, meaning you are paying for health coverage with dollars that have not been subject to income tax, which reduces the effective cost relative to purchasing equivalent coverage on the individual market with after-tax dollars. Understanding the health insurance options offered during open enrollment requires comparing the plans available along the dimensions covered in the insurance video. The premium, deductible, out-of-pocket maximum, and network coverage are the primary variables. A common mistake during open enrollment is defaulting to the most familiar plan type or the one with the lowest premium without calculating the total potential cost, including the deductible and out-of-pocket maximum. A high-deductible health plan with a lower premium may produce a lower total annual cost for a healthy person who uses minimal health care, particularly when paired with an HSA. A lower deductible plan with a higher premium may be more cost-effective for someone who expects significant medical expenses in the coming year. Running the numbers for your specific anticipated usage, rather than selecting based on premium alone, is the correct approach. The health savings account, when available through a high-deductible health plan election, is worth revisiting in the employer benefits context because many employers contribute directly to employee HSAs as an additional benefit. An employer HSA contribution is free money deposited into your account that reduces your effective healthcare costs and simultaneously builds your tax-advantaged medical savings balance. Even a modest employer HSA contribution of $500 to $1,000 per year represents real dollar value that appears only in the benefits documentation, not in the salary offer. Flexible spending accounts, commonly called FSAs, are a related but distinct benefit offered by many employers. An FSA allows you to contribute pre-tax dollars to an account used for qualified medical expenses or dependent care expenses. The tax savings are the same as with an HSA, as contributions reduce your taxable income. The critical differences are that FSA funds are generally use it or lose it, meaning unspent balances at the end of the plan year are forfeited, though some plans allow a small carryover or a grace period. FSAs are also not portable, meaning you lose access if you leave the employer. Because of the use it or lose it structure, FSA contributions should be sized conservatively based on predictable anticipated expenses rather than maximized without regard to expected usage. Dependent care FSAs are a separate account type from medical FSAs and are used for eligible child care and elder care expenses. The contribution limit is higher than the medical FSA, and the pre-tax treatment provides significant savings for families paying for child care, which is one of the largest expense categories many families face. Using a dependent care FSA for child care costs effectively reduces the after-tax cost of child care by your marginal tax rate, which for families in the 22% bracket means 22 cents saved for every dollar contributed. Life insurance and disability insurance are benefits that many employers provide at no cost to employees up to a base coverage level, with options to purchase additional coverage at group rates. Employer-provided life insurance is typically equal to 1 or 2 times annual salary and is provided free of charge. While this base coverage is usually insufficient for employees with significant financial dependence, it is free supplemental coverage that reduces the amount you need to purchase individually. Disability insurance is arguably more valuable than life insurance for most working-age people because the probability of experiencing a long-term disability before retirement is higher than the probability of death. Employer-sponsored long-term disability insurance typically replaces 60% of your income if you become unable to work due to illness or injury. Enrolling in this coverage when it is available is straightforward risk management that most people overlook because disability feels less immediate than other risks. Employee stock purchase plans, commonly called ESPPs, are offered by many publicly traded companies and allow employees to purchase company stock at a discount to the market price, typically 10 to 15%. The basic mechanics involve payroll deductions over a contribution period, after which the accumulated funds are used to purchase shares at the discounted price. The discount alone represents an immediate return before any change in the stock price, and many plans use a look-back provision that applies the discount to the lower of the stock price at the beginning or end of the offering period, which can substantially increase the effective return. The financial risk is concentration in your employer's stock, which already represents your employment income and therefore your human capital. Holding significant additional investment exposure in the same company amplifies the risk that a company-specific negative event affects both your income and your investment portfolio simultaneously. For this reason, many financial advisors recommend participating in an ESPP to capture the discount, but selling the purchased shares relatively quickly rather than holding them as a long-term investment. Tuition reimbursement and professional development benefits are among the most underutilized employer benefits available. Many employers reimburse employees for continuing education, professional certifications, and job-related coursework up to a defined annual limit. Under current tax law, up to $5,250 per year in employer-provided educational assistance can be excluded from your taxable income. Using this benefit for degree programs, professional certifications, or skill development that increases your long-term earning potential is one of the highest return investments available, particularly when it is entirely or substantially funded by the employer. Commuter benefits allow employees to pay for transit passes and parking with pre-tax dollars up to monthly limits set by the IRS. Using a commuter benefit account to pay for your monthly transit pass or work parking effectively reduces the after-tax cost of your commute by your marginal tax rate. For employees in urban areas with significant commuting costs, this benefit can save several $100s per year with minimal administrative effort. Paid time off, including vacation, sick leave, and parental leave, represents direct economic value that is often overlooked when comparing compensation packages because it does not appear as a dollar amount. The dollar value of paid time off can be calculated by multiplying your daily rate of pay by the number of PTO days provided. For a $60,000 annual salary, each day of PTO is worth approximately $230. An employer offering 15 days of vacation versus one offering 10 days is providing over $1,000 of additional annual compensation in that differential alone. Parental leave policies vary enormously across employers and have substantial economic value for employees who plan to have children. Comparing PTO and leave policies as part of a total compensation evaluation rather than treating them as soft benefits is the analytically correct approach. wellness benefits, employee assistance programs, and various supplemental benefits, including commuter subsidies, gym membership discounts, student loan repayment assistance, and others vary widely by employer and are worth inventorying and using where applicable. Student loan repayment assistance has grown as an employer benefit, and under current law, employers can contribute up to $5,250 annually toward employee student loan repayment on a tax-free basis, the same limit as the tuition reimbursement exclusion. For employees carrying student loan balances, this benefit is direct debt reduction paid by the employer. The practical action this video calls for is straightforward. Obtain the complete benefits documentation from your employer, ideally during the onboarding process or at the next open enrollment period, and go through every benefit offered with the question of whether you're currently enrolled, whether the enrollment level is appropriate for your situation, and whether you're capturing the full available value. Most people find at least one meaningful benefit they were either not using or not using optimally. The total dollar value of employer benefits for a full-time employee at a mid-size or large company can easily exceed 20 to 30% of base salary when comprehensive coverage, retirement matching, and tax advantage accounts are factored in. Treating benefits as an afterthought relative to salary understates the true economics of employment and leaves real money uncaptured.